The history of accounting dates back to ancient times. It is said that understanding accounting principles helps people to make smart decisions, lead strategic efforts, and navigate business challenges competently. In fact, it serves as the backbone of every successful organization. However, it is not limited to organizations. It can also empower individuals, not only in managing personal finances, but also in comprehending their financial health. This shows why learning about accounting is important. CSK Corp presents Accounting 101, Understanding the Basics. In this episode of Accounting 101, we will explore the fundamentals of accounting and understand the basics, definition, most common branches, and basic accounting terminologies. To start off, let us define accounting. Accounting is the process of recording, classifying, and summarizing financial transactions. That said, it provides a clear picture of the financial health of an organization and its performance. The accounting information exposes the company's financial performance. It tells whether they are making a profit or just running into losses at the end of the day. The world of accounting expanded into several branches that specialize in particular legal areas. For the basics, we will cover 4 of the most common branches of accounting. First, we have financial accounting. Financial accounting is the practice of recording and reporting financial transactions and cash flows. This is necessary in generating financial reports for the sake of external individuals and government agencies. The generated financial reports will show the performance and financial health of a business. Next, we have managerial accounting. Managerial accounting provides the reporting, analysis, and interpretation of financial data that decision-makers need to create and refine business strategy. It focuses on the use and interpretation of financial information to make sound business decisions. It is similar to financial accounting, but this one is reserved for internal use. Next up, cost accounting. Cost accounting is the process of tracking, analyzing, and understanding the costs involved in a specific business activity. It helps companies to ensure that they are spending money on things that benefit their business. Also, information from cost accounting is used to optimize operations, to value inventory, set selling prices for products, and create budgets for similar projects. Lastly, we have tax accounting. Tax accounting is the act of tracking and reporting income and expenses related to the company's taxes. It deals with preparing tax returns and making tax payments. It is important that accountants ensure that companies comply with complex and changing laws. These are 4 of the most common branches of accounting: financial accounting, managerial accounting, cost accounting, and tax accounting. Now, to fully grasp accounting principles, let's start learning basic accounting terminologies. Accounts payable. Accounts payable keeps track of how much money a business is making, as well as how much they are spending. Accounts payable also tracks the money a business owes to any creditors or suppliers, and ensures the numbers are accurate and can be paid off on schedule. Accounts receivable. Accounts receivable refers to any money that is owed to the company from customers or other businesses that have received their requested goods or services. It is important for businesses to keep track of who owes them money and how much they are owed, so they can ensure they are paid on time for the goods and services they provide. Accruals. Accruals are a type of record-keeping adjustment. It recognizes expected business expenses and revenues before exchanges of money take place. Assets. Assets are items of value or resources that a business owns or controls. They result from past business activities and are expected to generate future economic value of the company. Balance sheet. To keep track of the company's finances, a balance sheet is used to report what the business owns, what it owes, and other financial matters related to the company's profitability. Capital. Capital refers to cash and other assets that business owners can put into the company to help it succeed and grow. The 4 major types of capital include debt, equity, trading, and working capital. Cash flow. Cash flow refers to money coming into a business from customers and where money is being spent by a business. A positive number, or net gain, indicates that more cash flowed into the business than out, whereas a negative number, or net loss, indicates the opposite. Chart of accounts. A chart of accounts is a master list of all accounts in an organization's general ledger. 5 main types of accounts appear in a chart of accounts are assets, equity, expenses, liabilities, and revenues. Credit. Credits are accounting entries that increase liabilities or decrease assets. Debit. Debits are accounting entries that function to increase assets or decrease liabilities. Equity. Equity refers to the business owner's interest in a company and how much it is worth. It is measured by calculating the difference between assets and liabilities on the balance sheet. The difference represents the value of a business, which can be a positive or negative number. General ledger. The general ledger is the master account containing all ledger accounts. It holds a complete record of all transactions taking place within a specified accounting period. Gross profit. Gross profit, or gross income, defines the value of the products and services sold by a business before factoring in the cost of goods sold. If the gross profit is a negative number, it is instead called a gross loss. Income statement. An income statement is a type of financial document businesses generate. It specifies the total revenues earned by the company in a given accounting period, minus all expenses incurred during the same period. Liabilities. Another aspect of accounting involves keeping track of how much a business owes, also referred to as its liabilities or debts. Net income. Net income, also commonly referred to as net profit, describes the total amount of money a business has earned within a certain period. This can be calculated by subtracting all expenses from a company's revenue. Return on investment. Return on investment, or ROI, describes the level of profit or loss generated by an investment. Accountants calculate ROI by dividing the net profit of an investment by its cost, then multiplying by 100 to generate a percentage. Revenue. Revenue describes the income a business earns by selling products and/or services associated with its main operations. Trial balance. A trial balance is a report of the balances of all general ledger accounts at a point in time. Accountants prepare or generate trial balances at the conclusion of a reporting period to ensure all accounts and balances add up properly. And that is about it for the basic terminologies. Understanding these terms is essential for anyone in order for them to understand accounting. And that concludes Accounting 101, Understanding the Basics. We hope you learned a lot from this video, from the definition of accounting, its most common branches, and its basic terminologies. If you want to learn more about accounting, follow us on our socials. Thank you for watching.